Okay, folks. So now we're going to talk about cash flows. This is going to wrap up chapter one. We'll talk about cash flows in the financial market. So what we have represented here, basically, you see this box on our right, this I guess slate, blue box, whatever you want to call it. Total value of the firm to investors in the financial market, right? You can see we have the financial markets here. This is short-term debt. These are notes payable, long-term debt, 20, 30 years, stocks or bonds, and then equity shares. You have the stocks and things like that, right? Okay. That is, if you want to think about it, that box just represents all the money that there is out there in the market. Okay, so that's kind of the piggy bank. Okay. Um, Now, on the other side, we have total value of the firm's assets. Okay, so what we get into here, if you want to think about it this way, this is your looking at kind of like your capital budget here, and this is your capital structure here. Because remember, we said money comes from debt or equity, and that's what this market represents over here. Okay, so when we're looking at that, the firm's been growing, things like that. And everybody knows, let's talk about Amazon right now. Okay, so Amazon, Jeff Bezos started in his garage. It started to grow. He wanted to get big. To do that, he needed money. So he knew what he wanted to invest in his capital budget. He needed warehouses, infrastructure, planes, trucks, things like that. So he goes to the financial markets, the capital structure there on the right. Okay, and when it comes to the stock or to the bonds, they give them loans and things. When it comes to stock, this is in the primary market. So this is the banks. When we're talking huge dollar amounts, they go to the firm, Amazon. Hey, we'll give you this much money. We want these many shares of stock. They get that, right? Okay. So Amazon gets that money. What does he do? He invests in his assets, invests in his fixed assets. He does what he does. The business, whether it's Amazon or other companies, they do what they do, whatever it is, whether it's buying and selling product, whether it's making cars, making TVs, electronics, whatever. Okay. So they do what they do. They're generating business, generating profit. All right. And you can see what happens. So as they do that, now money is going out. Okay, from the firm. Obviously, some of it's got to go back to the government. We pay the government and stakeholders, taxes, whatever. Obviously, some of it's going back to our investors because that's what keeps our financial market working. They're getting the dividends, they're getting the coupon payments, the interest payments. Now they have money to reinvest in other businesses. They find another business, and the whole cycle can start again. Okay, but the key thing here is look where the biggest arrow is. It's right here, and notice it is going back to the firm. This is called our plowback. This is going to be our retained earnings. We're reinvesting it back into the firm, and we're funding our own growth. Okay, so this is how the markets work. Now, that's kind of the cycle of the market, and that's kind of like a perpetual motion, if you want to think about it, perpetual financial machine. We invest in firms, they are profitable, they pay us back in interest and dividends. That goes back to the piggy bank, the financial market money, and then they have that money to reinvest in new firms and things like that. So this thing can keep going and keep generating funds for other companies. Okay. Now, when we look at this market, there is a primary market, and we already mentioned that. Okay, that's where the bank is giving money to Amazon or whatever that company is, huge dollar amounts. Okay, now the firm is doing what they want to do. The bank itself does not really want to be a stockholder. They don't care about being a stockholder. It's going to take them a very long time for them to get their money back. So what they do is they go from the primary market to the secondary market. Okay, and that's where stocks that are already issued are transacted to new buyers and sellers. So what happens here is the bank has all these shares of stock. They don't want to sit on that stock because they know it's going to take them forever to get their money. So what they do is they do what they call an IPO, initial public offering. Okay, and what they look at is the firm's growing. What happens is everybody knows Amazon. Amazon's getting ready to come out with their IPO, their initial public offering of stock. It's going to be a big thing. So let's look at the markets here, and we see the financial markets. So what we're talking about generally here is the New York Stock Exchange. When they're talking about getting this out to the secondary market, they put it out there. Don't you want to own Amazon? Look how big they're growing. They're a big company, but they're only in their infancy. They're going to take off. They get everybody all excited. And let's say the bank only paid $60 a share for each share of stock from Amazon, right? Now what happens is with the IPO, they're building it up. People are getting interested. Wow, Amazon, I know. Wow, internet buying. This is going to be the wave. Everybody gets excited. And then when that stock hits the market in their IPO, now it's worth $70 or $80. I can tell you, hopefully you know what Alibaba is. Basically, it's the Amazon of China. And I was watching this before class one day, and they said Alibaba's IPO is going to come out at 60. And so the market's open at 9:30. Everybody said, hey, it's going to hit at 10 o'clock. Well, at 10 o'clock, they're like, well, we're still working out some things. It's going to be 11 o'clock. But Alibaba, look at what Amazon did. Alibaba's going to be Think about Amazon in China with 3 times the population. How big is that company going to be, right? Next thing you know, the stock went from $60 to $70. And then 11 o'clock rolled around, and it was like, well, we still got a couple things to work out. We're not going to issue it just yet. It's going to, we're going to work these things out. But in the meantime, they just kept talking about Alibaba and stuff, and the stock went from 70 to 80. And I forget when it actually hit the market, but it hit the market at $90 a share. So think about the banks and what happened here. Okay. Maybe they paid $60 for that share of stock. They got everybody in a fervor about the stock, and when it hit the market, it actually came out at $90 a share. So in essence, the bank got what they wanted. They didn't want to be a stockholder. They needed cash flow. They wanted money. So they do that. Now they've made their money back and so much, 50% more. They're out of it. They've got their money. They can go back to the market and look for other companies to invest in. And then we as stockholders, now you and I are the stockholders of Amazon or Alibaba, and we're the ones waiting for the dividends to come in and that stock price to go up. Okay. So that's the difference between the primary market, the bank dealing directly with the company, and the secondary market where you and I are buying the stock. Okay. Now, we also talk about dealers, stock dealers. Think of stock dealers as kind of like car lots, a car dealer. You're buying and selling inventory, meaning the stock, out of their own inventory. Okay. So they have it in their pocket. You buy Alibaba, they're pulling it out of their pocket, selling it to you, pulling it out of their inventory. If you sell it, they're going to give you the money, take that stock, and put it in their inventory to sell it to somebody else. Okay. You also have auction markets where this is kind of like brokers. You got somebody putting buyers and sellers together, and you're bidding against each other to see who's going to get the price get the stock at the price they want. Okay. We also think about the New York Stock Exchange. Now, with the stock exchange here, New York Stock Exchange, remember that's in Wall Street and it's downtown. We'll get a little bit more into this when we get into chapter 8, when we talk stocks specifically, but that's an actual physical market. And really it's the last physical market in the world. Just about everything else has gone digital. Okay, and the same with the NASDAQ here. National Association of Stock Data Analysis and Quotes, if I remember right. And it's just an over-the-counter market. Basically, this is just where transactions are, they report the price of their last transaction. This started as a tech, mostly tech stocks are here. Namely because when it started, you had small companies that needed capital. They weren't big enough to be on the stock exchange, so they used something called the internet back in the 70s and 80s before it was a big thing, and put the word out there to other tech savvy folks, hey, we need investors. And they invested in the company. That's kind of how the NASDAQ grew. And again, we'll talk more about that when we get to chapter 8, talking about stocks specifically.